Welcome to my first episode of Dollars and Cents, but as always, we're going to keep it real, as in real estate. Every month, I plan on giving you a new topic with regards to how to make the mortgage process easier and get the best possible deals available. And the first thing we're going to talk about is your credit report. A lot of people come to me already thinking they know they have excellent credit, so they wait until the very last minute. They've been to Credit Karma, they've been to My FICO, and all they want is, give me the 3.875 that's out there. And unfortunately, I pull their credit, and that's not in the cards for them, and we don't have enough time to fix their credit. So what I plan on doing today is going through a few questions that were given to me, just to kind of go over some of the misconceptions and things that you should know when it comes to credit. First question I have is, what is the difference between a consumer credit report and a mortgage credit report? Good question. So consumer, believe it or not, there's over 30 different types of credit reports out there for all different industries. You've got a credit score system for credit cards, you've got a credit score system for insurance, for automobiles, and most importantly for your mortgage. So when you go out to these the Credit Karmas, for instance, they're going to give you a range. You have bad credit, you have good credit, you have excellent credit, you have average credit, but they're not going to give you a score, and they're certainly not going to give you the score that we're going to use to determine ultimately the deal that I'm going to be able to present for you at the closing table. So best thing you can do is the sooner you get to a mortgage professional, have a mortgage credit report pulled, the sooner you know what kind of score you have, and then we can maybe put some small little changes in place to hopefully get you the best deal down the line. Second question we have is, how does my credit score affect my down payment and my rate? Another excellent question. So again, most of you know I've been doing this over 20 years, and you go back a long time ago, 20 years ago, credit scores and loan to value didn't play that much of a role. I mean, you did have to have certain scores to even qualify, but it wasn't tiered based on your credit score and your loan to value the way it is today. What does that mean for a consumer? Well, for instance, you can have really good credit, pay your bills on time, never had a late pay, no collections, no judgments, and because of the timing of the month when you pay your credit, or maybe the amount of available credit that you have, you may end up with, let's say, a 699 FICO. Okay, so you come to me, you think you have excellent credit, and you do, but you've got a 699 FICO, as opposed to really excellent credit would be a 740. 20% down, the same two scenarios exactly. So you've got, let's say you're going to buy a $500,000 home, you're going to borrow $400,000, 20% down. One person has a 699, one person has a 740. Do you know what the difference is? $5,000. It costs you $5,000 more to get a loan at 699 than it does at a 740. And you're either going to take a higher interest rate, or you're going to pay $5,000 more at closing to get the same deal, the same rates and terms that 740 is going to get. So the sooner you come to me, we can make some little tweaks a lot of time to improve your score 20, 30, 40 points and get you that deal. Final question here. Will my credit score continue to get worse each time a lender pulls it and while I'm shopping for a mortgage? Can I shop around, or is it going to continue to hurt me with everyone I talk to? And the answer to that is you can. You have about a 14-day window to go out and shop rates between different lenders, get different loan estimates, possibly even get advice on what kind of product is right for you. But every time, if you go down the street and you get a mortgage credit report pulled, and 2 days later you want to talk to me and get it pulled again, I'm going to not only get the exact same credit report that they get, we're going to get the exact same score. So it costs you nothing to do that. That was put in place for a reason, because you as a consumer should be shopping around. No matter if you've got 800 FICOs or 600 FICOs, it's not going to hurt you, as long as you do it within a 2-week window, to talk to multiple lenders and get the best deal out there. All right. Well, some great questions today, and I appreciate all the feedback. So we're going to take a quick break, and when we come back, we're going to talk to Ben Dodd. Ben owns a credit repair company in town called Freedom Credit Solutions, and he's also a certified FICO expert and has 19 years experience in the mortgage business. So stick around, and more to come. So just a few points off of your credit score can cost you thousands of dollars. Many home buyers don't even think about the impact of their credit score on their actual mortgage rate until it's too late. A difference of just a few points on your score can raise your rate enough to cost you an extra $100 or more every month. I've seen too many cases where a home buyer waits till the last second to get pre-approved, and only then do they realize their scores simply aren't where they should be. Fortunately, it's not hard to improve your score if you have enough time. Reach out to me as soon as possible when you start considering buying your next home so we have time to make those adjustments. I can give you some simple tips to improve your credit and potentially save you thousands of dollars over the life of your loan. Shoot me a message and let's chat about the steps that you should take first. Okay, so I'm here with Ben Dodd from Freedom Credit Solutions. We're going to talk a little bit about credit and credit repair. Ben, thanks for joining me.
Thanks for having me, Ron.
Yeah. Tell me a little bit about your background.
Well, we've known each other for a little while. I've got 19 years in the mortgage industry, owned a mortgage company for 10 of those, but I saw a real need for people that are struggling a little bit on credit, and I kind of switched over and handled, we have an attorney-backed firm that handles credit remediation, and primarily we handle the mortgage industry, the people that are being told no for mortgages due to credit.
Right, and that's why I wanted to have you here. Let's talk a little bit about FICO. I mean, what is it and why is it so important?
Yeah, FICO is like a household name now. It wasn't probably about 10 years ago, but everyone wants to know what their FICO score is. And what a lot of people don't know is that FICO is, your score is different depending on what you're going to buy. So there's different scoring models for mortgages and insurance and autos and all that. But FICO is just a company that takes data and spits out scores based on computer algorithms, and the data usually comes from the three big credit reporting agencies, which is Experian, TransUnion, Equifax. So that's where they get the data. All that data is generally how you pay, what you pay, and who you're paying to on finance.
Right, and the scores can be completely different depending on what you're doing, right? So it's not just what hey, here's my FICO. It's when someone asks, hey, what's your credit score? I know you and I joke, but it's kind of like, well, what are you trying to do?
What do you want to buy? Right.
So, and that can be, whether it's insurance, whether it's a credit card, whether it's an auto loan, or whether it's a mortgage, and there's a lot more in between.
And they're tailored to what exactly they're buying. So, I mean, and there's a lot of misleading things. Credit Karma actually spits out a score. I mean, how many times have you had somebody say, my credit's excellent, and you go to pull a FICO mortgage report and the score's significantly less. We see that all the time.
Yeah, and the unfortunate thing is when those scores are not at their absolute peak, and you'd be amazed, but depending on the product that you want and kind of how much you're going to put down, a credit score anywhere from 740, I've even seen benefits for being above 760, and certainly, loan to value, we can get into that, but all the way down to maybe a 550, and they're tiered about every 20 to 30 points. So you're going to get a different deal. Every 20 points we can get you, you're going to get a different deal than the next one, And so I think that's why coming to me and possibly even yourself as soon in the process as we can.
Yeah, we like people to know what's on their credit, obviously, ahead of time. But as you know, people are shopping for homes kind of backwards. They generally might drive by an open house and go, wow, that's that house we've always wanted to live in. They go in and they're excited, and then it comes to you, and then you pull credit, and maybe they don't qualify, and it's unfortunate.
Yeah. Or they do qualify, but they're not able to get the best rates in terms available because, in this market, there's not a lot of inventory. And so what happens is if it's that great home that they drive by and they love, there's probably some other people that are going to do the same thing. And what I've seen happen more often than not, and I'm sure you see the same thing, it's not necessarily the guy that knows that he kind of slow pays or know that he's missed a couple of debts here and there. It's the guy that says, I have excellent credit because I pay all my bills on time.
Right.
And that...
Which makes sense.
Yeah, I mean,
that's great.
It sounds great, right? Tell me the flaws in that theory.
Yeah, so the problem with that is who are you paying? What type of credit accounts do you have? And also, what about the things you didn't know about? What about those past debts? Maybe there's some medical stuff you didn't know about because you don't have your credit pulled or you don't know what's on your credit. So you see that a lot. But generally, what you pay and when you pay is really important because let's say you pay on your due date. Well, usually if you pay on your due date, especially on a credit card, and let's say your balance is up a little high, but you pay a significant amount or you pay it off. The problem is if you pay it on that actual due date, you're not going to get credit for that payment on that date. So they may report to the bureaus the next day and it's still going to look like you have high balance limit ratio. And that's 30% of your score is based on utilization. So if you're pulling a credit report and the utilization's high, it's going to have lower scores than if it reported the payment.
Yeah, and I've used this example before. I've seen people that they may have $10,000 available on their credit card and they put $5,000 a month on there. And they've got it set off to pay every month on the last day that they can, possibly pay it, and maybe it's due at the end of the month. And so what happens is when I pull credit,
that's right.
I inform them, hey, you owe over $10,000 on a credit card that only has $10,000 available balance. And they say, well, that's impossible. I pay it off every month. I never run it up more than $5,000 or $6,000. And it's because of the date that they're paying it. And when you start seeing credit utilization at 100% or more on a revolving credit card,
significant drops.
It's really significant. And so you're not going to get to call up and say, I have excellent credit. I pay my bills. I've got,
Just not good enough.
I want the 3875 that's out there now.
That's right.
Unfortunately, if you got to move fast on a new home and you pay your bills, but you pay them on the last day of the month and on the due date.
Yeah, you're not late.
But you may end up finding yourself with a credit score less than 700, and it's going to hurt your score.
Yeah, that's one of the top tips that I give people that are heading up to qualify for a mortgage is pay about 10 days in advance.
Right.
Focus on those credit cards. Get the balance limit ratios down below at least 30% limit ratios. Also, if you have more than 3 credit cards, don't have balances on all 3 or 4 or 5 or 6.
Right.
Try to have some down paid off. Because those things that utilization is still looking kind of high on some things.
Yeah, and I mean I've seen it many times. I've had really qualified people that come to me, and the problem with them is they've never really called their credit card companies and asked for their available balance to be raised. So
it's a great trick.
Hey, I don't put a lot of money on my credit card. I've got a $2,500 available balance, and I probably don't put more than $2,000 a month on credit. Okay, well, call them up and tell them you want them to bump you up to $10,000 a month available credit. Generally, and your scores are going to improve.
Yeah, if you're running a low balance limit ratio, you've had a card for 12 months, they'll happily increase your limit. They're going, the potential for you to spend more with us.
Potential for you to pay a high interest to a credit card is what they want. So if you're paying it off, just call them up, get the available balance increased. I'm not saying spend more money on credit cards. Spend exactly how you've been spending, just have more available.
Yeah.
So
great trick. That's really what happens. And I've also seen husbands and wives that have 2 different credit cards.
Yeah.
Well, you have somebody who has a credit card that's been open for 10 years and has a huge available balance with a low limit. Add on as an authorized user. I mean, there's immediate score increases because, again, it looks like your extended credit, but you don't need to use it. That really bumps the credit scores.
And you can get that other person, that spouse's credit history of paying on time. So
length of history is 10% of your score again. So there's 40% of your score right there. You as a consumer can affect and increase before you apply for a mortgage. So.
Right. So let's say we get the consumer that does things in the right order. They start with me long before they want to go out house shopping, even before they start going out to, dare I say, Zillow. I know it's a bad a bad word to, and actually it was always a bad word to realtors. Now it's a bad word to lenders as well because they're getting into that game. But but before you start looking around, whatever means that may be, let's say they do it the right way. They come to me. I give you pre-approved for the house of your dreams. At that point, what kind of mistakes can a consumer make to ultimately change the deal they're going to end up with, or to no longer be pre-approved when they actually find the home?
I mean, I remember back in my mortgage days, I've had people that have gone out and bought a car. It's like, no, what are you doing? And, debt to income ratios are in. But applying for credit can really hurt. It can hurt, especially in that particular phase of getting your mortgage. So doing that, finding out some things on credit that they didn't know about, maybe a little medical collection or something like that, and it's a small dollar amount. So they go, hey, I'm just going to pay it, and it seems
like the right thing to do, right?
It is. This is a little thing. It's only $100. Hey, maybe it'll just help my scores a little more. That's a big mistake a lot of times because medical collectors are on there for a reason. They're there to collect the money. But if you pay them, you're admitting to owing them. And what that does is it resets the debt. So you may have a zero balance, but it's a Code 9 collection, which is the worst. And it's going to restart that date from the date you pay it. So it may have been a 5-year-old account, which isn't hurting your score probably anymore. But once you pay it, it's immediately going to show up as a brand new collection that's paid off. Well, it's immediately going to drop your scores, just like a brand new collection showed up on there. So it actually can damage your scores as opposed to fixing it. We don't pay collectors at our company. We pay original medical providers, or we get it removed from credit, and we're really good at doing that. So.
Right, a lot of great stuff, and there's a lot of tricks. I mean, certainly if you come to me first, I've learned a lot over my 22 years and can help with a lot of this simple stuff. But when you start talking about long-term improvement of credit for the long haul, maybe credit monitoring, things of that services, that's what Ben's here for, and certainly something that you can come to me, you can reach out to Ben directly, but just trying to offer some advice so that we can give you the best. And Ben knows this. I mean, even on the mortgage side, he did it forever. We do want to get you the best rates and terms. I don't make a nickel more whether you come to me with a 620 FICO or a 720 FICO.
That's right.
Whatever you, I mean, percentage of loan amount is how I get paid. So I don't, while I do care and I want to get you the best deal available, I don't want you to think that I have any incentive for your score to be anywhere. The only incentive I have is to give you the best deal. So, Ben, it's been
Thank
great.
you very much.
Hey, thanks for all the knowledge. And look forward to maybe speaking with you in the future about more credit
I like
needs.
that.
All right,
Thanks,
thanks.